Hello, hello. I get a lot of questions on how to choose individual stocks, and if I had to boil it down to a simple process, I'd say that I follow these three rules. You must achieve situational awareness. You must choose competitive companies with long-term compounding potential. You must only buy things that are trading well below their intrinsic value so that they have a margin of safety. So I'm going to cover these three things in much further detail going forward, but today I'm just going to talk about an overview of what this process looks like. Okay, so rule number one, situational awareness. You have to choose industries that you actually understand. This is one of the core lessons from value investing. Warren Buffett likes to refer to this as his circle of competence. There's an excellent video here. It's very short. I recommend all of you watch it. The core of it is that if you don't understand how the industry works, you should just avoid that company. You should move on to some company that's in an industry that you actually do understand, because part of this is that you have to have a thesis about the industry. And if it's an industry you don't understand, your thesis is inherently going to be flawed, because you need to have some sort of an idea of its long-term potential. And a big part of that has to do with the business life cycle. Every company you would ever want to invest into is in an industry, and you have to understand where that industry is in its maturity stage, and also where the business is in its business life cycle. The rules for choosing companies that are fully mature are different than the rules for choosing companies that are early in their business life cycles. So when I look at high yield dividend payers, I use different criteria than when I'm looking at growth stocks. So if you want to gain additional awareness about an industry, you can look to a variety of places. You can look at news articles, you can go to Wikipedia, you can get on YouTube. But my primary recommendation is to stick to industries that you already know. In addition to understanding the industry, you also have to understand the business model that company is using within that industry. You can get information on a company's business model by reading their company summary, but the best place that I can send people is to go read their earnings call transcripts. Those will usually give you a fairly clear idea of what the company does that generates money. You also have to assess the quality of management. The number one place I go to for that is interviews. Most CEOs will go do live interviews. Just watch a bunch of the interviews. Get a clear picture in your mind of how competent the CEO is. And are they a good decision maker, or are they merely a good salesman? This will come into play more when we get to the financial section, but it is easier to identify bad companies than good ones. It is also easier to find a crook than a genius. Okay, so rule number two. You must choose competitive companies with long-term compounding potential. The compounding potential part is actually much easier to identify than the competitive part. Competitive companies have what is referred to in the value investing world as moats. They have an unfair competitive advantage over their competition. Typically, most of the time when you find a duopoly or a monopoly, those businesses have significant moats. When it comes time for me to evaluate competitiveness, I go to game theory to get those answers. I do basic Nash equilibria based off of consumer habits, and then I also do a separate set of Nash equilibria based off of competitor reactions. The goal here is to identify how the rest of the world is going to react to this company's business model over time, and how they might react to changes the company makes to their model. When it comes to assessing their long-term compounding potential, I look at financial statements, and the most important parts of the financial statement are not actually on the statements. You have to do math to get those. They are margins and returns. When it comes to margins, I look at gross margin, operating margin, EBITDA margin, net income margin, levered free cash flow margin, and free cash flow margin. When it comes to returns, I look at return on invested capital, return on capital employed, and return on equity. I will go into further detail on all of these in another video, but there are two important things I need to point out here that come from the financial statements. Only invest into growth companies if their cost of expansion is low, and only invest in dividend companies if they are drowning in cash and buying back shares. Rule 3. Only buy things that are trading well below their intrinsic value with a margin of safety. You want to buy things when they're cheap, when they're on sale. You want to avoid hot companies in hot industries because if it's in the news and everyone is talking about it, it's overvalued, so don't buy it. There are many different ways to calculate intrinsic value. The ones that I like the most are the PEGI method, the dividend discount model, a gram number, and a discounted cash flow. There are also a variety of ways to value pre-profit companies. These are companies without positive net income. These valuation methods are typically less reliable, but they're still available to us. Because markets are auction-driven, the market price is allowed to swing wildly both above and below the intrinsic value of a company. When you buy something that is well under its intrinsic value, you end up buying with a margin of safety. This not only increases your potential returns, this also lowers your risk. So these 3 simple rules keep me from making bad investments, and I plan on doing a deeper dive on all of the topics that we covered in this video in future installments in this series. So if you want to catch those installments, subscribe.